Should I move to the module 2?
Yes. I think you should finish module 1 and 2. So
Okay.
then we can open the floor for question later.
Thank you. So in module 2 is connecting to module 1 as well on the capital structure and cost of capital. Let's understanding what are this capital structure and cost of capital. The capital structure is the concept incorporated in finance and impact how business are funding the operation. For this concept, we can see how to optimize the financial decision. We will examine the trade-off between the debts and the equity financings. What are the advantage and what are the disadvantage? And also we have to understand what are the weighted average cost of capitals in the organization. The capital structure fundamental identify into three fundamental. One is optimal mix, which is balancing the risk and the return. Number 2 is on the equity financing, that's selling ownership of the stake of the company. Number 3 is on the debt financing, that is borrowing in terms of loan or bond for the company. The capital structure represents the specific combination of the debts and the equity of financial in the company, that we need to consider several factors, including the interest rate, the growth opportunity, and prevailing economic conditions. In order to make the right capital structure decision, they are not specific in any numbers, and those are various depending on the industry. For example, the financial industry operated with a higher debt to equity ratio, while technology company with a lower debt to equity ratio. This is in order to maintain a low leverage and the risk assessment for this operation. So the next we will define what is the debt versus equity trade-off. Let's find out what is the advantage and disadvantage of all these two, debt versus equity. The debt advantage is the interest payment for the debt is tax deductible, and the ownership do not need to dilute the share. The lower cost of interest in specific country will give the advantage on the debts, while the higher interest rate will give more disadvantage. The disciplinary effect on the management. The disadvantage of debt is mandatory repayment schedule that make the financial distress of the company, and restrictive conversion and limited flexibility. While for the equity, the advantage is no repayment obligation compared to the debt, flexible dividend payments, the lower financial risk because we don't have the commitment to pay back as mandatory payment schedule, and access to equity investor expertise. Once you have the investor in to the company, you can access to their expert and their knowledge in order to improve the operational, the process, and the profitability of the company. While for the equity disadvantage is the ownership dilution of the share and high cost than debts. High cost than debt we have to compare. Usually the investor, they would looking for more profitable at the end of the investment life cycle, so that it would be higher than the interest rate if we compare to the debt. And the dividend payment not tax deductible, and potential control issues because of the equity share the investors can make decisions in the company. So the company must carefully to balance this debt trade-off, this capital trade-off, whether you take the debts or equities. During the period of low interest rate, the debt financing is typically become more attractive and lower cost and tax advantage. However, if we take more debts, that increase financial risk for the whole company operational. And let's understand some calculation about the cost of capital that identify as following. Number one is on the weighted average cost of capital called WACC. The WACC, we need to know about the equity value, the debt value, the total value, the cost of equity, the cost of debt, and the tax rate. The cost of debt is the interest rate that paid on the debt, which have to be adjusted with the tax benefit. And the cost of equity is calculating using the capital asset pricing model called CAPM, which we need to understand on the risk, so-called as the risk-free rates. Those risk-free rate, for example, US Treasury risk-free rate for now is 4.25, and we also need to know the market return. Market return is on the market return of rates that investors are looking for, and we calculate it into the cost of equity. And the last step is the project valuation. We using the WACC serve as the handle rate for investment decision. The project must yield return exceeding the WACC to create value if we want to balance on the capital cost. The capital cost is representing to minimal return on the company must earn on the investment to satisfy the capital provider. For example, the investor, the bankers that providing the loan to the company. And to determine the cost of equity is more complex, as equity investor require more returns and the investment life cycle as well that we need to discuss. Optimizing the capital structure to make the decisions. Number one is industry benchmark. We need to compare which specific industry, what are the debt to equity ratio of our industry. It is high gap in different industry. For example, comparing the financial sector is 3 to 1 on the debt to equity, while for the technology is 0.5 to 1. The next one is the growth stage consideration. For early stage company, for startup company with high growth potential, would be favorable for equity financings because it is accessing to the expertise from the investors and lower risk on the financial repayment compared to debts. While for major company and stable cash flow, debt is one of the options. And need to consider about the economic environmental analysis. For some country, the interest rate is low. Some country interest rate is high. For low interest rate, the increasing in debt proportion may reduce the overall cost of capitals. However, the company must consider the potential interest rate increase. For example, for the last few years for US, they increased the interest rate to a very high, but for last year, they are dropping a little bit of the interest rate. and this creating the uncertainties. So the company have to balance on this trade-off and need to keep monitoring on their cost of capitals. The last one is the tax situation and evaluation. The company with high effective tax rate benefit are more benefit from the tax sales that provided the debt interest payment because the debt interest payment is tax deductible. In order to optimal capital structure, minimizing the cost of capital while maintaining the appropriate financial flexibility, financial manager must continuously monitor and adjust capital structure in the companies, whether you are using the debt or you are looking for the investor to invest. And also need to think about the business condition, the growth opportunity and economic environment involved in all this financial costs. So this is the end of my presentation. I would like to welcome if any comments or any question. Thank you very much, doctors.
Oh yeah, thank you so much. I got the point regarding to capital structure. That's very interesting. Capital structure you present consists of debt, equity, and another one's called hybrid mix.
Yes.
Do you think, for school, do you think it should be run only equity budget or equity capital, or we should do mix? Which one do you think is good? And can you provide pro and con or benefit? Let's say if you use only equity, what is pro and con, and if you use mix, and how is your recommendation for school?
Yes, very good question, Dr. Visna. And for capital structure for school is depending on the financial situation of the school as well. For example, if the school want to expand very, very fast and they are distressed on the financials, they need to think about what is their annual return of the school, the net return, whether they are capable in terms of repayment to the debt or not. Those they need to consider about their debt options, whether it is good for the debt or good for the equity. If they want to expand fast and their financial capability is not strong to pay back the debts on the repayment schedule, then they can consider to look for the equity investors in order to invest into their company. The advantage of equity investor in school is they can make the company value higher, and they can minimizing the risk of financial distress in terms of repayment schedule to the debtor, to the bankers, to the financing institutions that giving the debt to them. So it's really depending on the company's situation. If their financials is stable, their cash flow income is stable, they can generate very good net profit and net cash flow, and they are able to pay for the repayment schedule of the debts, and the interest negotiation is good, then they can consider about the debts financings. However, they need to consider another point is on the situation or the requirement of the debts financings. As Cambodia, mostly all the institutions, all the bankers, let's say 90%, 95%, they are looking for the collaterals, hard collaterals, in order to put as a collaterals to give you the debt. And very, very, very minimum, very small percentage of banker that they are able to give you risk-free debt. So in terms of negotiation, in terms of financial strength, we need to balance all these two. Some school, some situation, they can use a mixed balancing of the risk and the return by using both debt and equity. They use the debt in terms of their net cash flow in is able to pay to the debts. Then they take that sum of amount in order to secure for the expansion of the school. However, if they want to expanding faster, they have to look into the investor for the equities financing. Thank you, Dr. Stan.
Oh, yes. Mr. CFO, Mr. Samen, can you share more? Because I got that you have a lot of experience about managing finance, managing capital. Samen, are you here?
Yeah, I'm here, but my internet is not stable, so I lost some of your question. Can you repeat your question? Sorry.
Your position as CFO, and you got a lot of experience about managing finance for education business. Can you share more, about capital structure, because we are talking about debt and equity, and then which model we should run business only equity without having debt, or we should do mix debt and capital together, or if we choose mix, which rate you think is good?
Okay, so usually people like debt, right? We like leverage. We want more leverage. Why? Because we want to spend other people's money. I mean, there's always a theory like, hey, you use other people's money and make your own, something like that, right? So it's very popular. So debt is always very popular, and also cost of debt usually it's less than if we put our own money. If we put our own money, where do we get that money from, right? So a lot of costs behind that one. But if we get the money from the bank, we only pay those interests. Also other people helping us protect our business, protect our operation also. But when saying that, we can't say, okay, I want 10 million, 20 million, and then we get it, right? Regulator, bank, other people, they also have their own regulation. For example, they say we only allow 1.5 debt to equity, or we allow 2 times of your equity only, for example. Or they look at debt to net profit or debt to EBITDA, something like that. We only allow 2 times of debt to EBITDA only. So if our EBITDA right now is 1 million, for example, then we can only take 2 million debt. So the decision first, let's say if we want to expand, let's say we create new campus, how much is that capital? How much do we need to fund? Sorry. 1 second. So how much is that capex needed? And then there must be always a mix because the bank also having that ceiling, debt to equity ratio, debt to net profit, debt to EBITDA, debt service coverage, all of that. We need to balancing. I'm not sure that answer your question.
Yeah, that's good. That's good. But I want to hear the thought from Miss Chairwoman, because her thought actually from fund management company. How about you? How about you?
Well, not just from the fund management company, but from the financial institution perspectives as well. So to start, capital structure for a company is always very complicated. It's not as straightforward as an equity or debt. So it's always combination. And in real world, it's not just a combination of debt and equity. So we have equity, we have like common share, preferred share, debt, we have subordinated debt, we have senior debt. So all of this combined. But end of the day, the bigger the business, the bigger is the business side, the more complexity it is in terms of the capital structure. But always the consideration to come up with how you balance this, how whether you should take debt or you should take equity or you should take subordinated debt or you should take senior debt or you should take preferred share. It's all come back to the cost and benefit of each option. Bong Pheng already mentioned in his presentation, the leverage. So the key term here is about the leverage. And each business or each sector have different leverage. I was running the financial sector before, financial institution. And the typical leverage rate for the financial institution, MFI here in Cambodia, is 1 to 5. You can say debt to equity ratio of 20%. So one equity, you can leverage 5 debt. And why it is allowed to be that high? Because this is in the highly cash liquidity or highly liquidity sector. You need you are able to operate with that. But in trading company, this debt to service debt to equity ratio, it can be maybe maximum of 2. So for a company that is really that need a lot of liquidity, they may be allowed to up to like 2 or maybe 3 in some case, because cost for debt is always cheaper than equity. It's always because as an equity investor, we're looking for return of 15, 20, or even more than that. No investor looking for less than 10% investment return in any country, But for debt investment, you can get 6%, 7%, or 8%. And also, debt is for a specific period. So you take the debt for 3 or 5 years, you paid it off, all your obligations gone. You take equity, your obligation is throughout your whole life, unless you buy back that investment from the investor. So for sure, debt is always cheaper. So that's from the financial perspective. But of course, the risk coming from the debt is always higher. Like Bong Pheng mentioned, so we have the liquidity risk. So in the startup business where you are struggling in terms of raising inflow, cash inflow, then it's not considerable to take debt because you won't be able to service it. But in the business that you have, you are highly liquidated, then you can take the debt and making sure that you take the debt in the level that you can service it. So it's all of this consideration combined. But it's always better to mix all of this because you want to maximize your profit. The only reason you take debt into your business, into your capital structure, is because you want to maximize the profit generated from the shareholder. If you don't take debt, then the return for the shareholder is always lower than the rate that you can get for the shareholder if you take debt in. But if you take more debt, then you might not be able to service it, meaning that you are losing the money of the shareholders as well. So that's why these are the trade-off that you need to consider in terms of designing your capital structure.
Yeah, I love you all sharing. That's a very good thought and very good lesson for us. Thank you. Dr. Chris, Dr. Sa, do you have any comment or any thought on this?
Hello,
Okay, absolute. Dr. Thani, please.
ผมสวัสดีครับอาจารย์ศักดิ์ครับ Dr. Vesana and team, I listened to your presentation starting from young lady to men. I look like I sit in the forum of financial team in in the organization. You are very professional and everything okay for me too. I think you will be the PhD student and to be a doctorate degree like completed people also. Yeah, go ahead and have a good day. I'm Thani. Yeah.
Thank you, Dr. Thani.
Yeah, thank you very much indeed. This has been a very interesting morning for me. I'm not really from a financial background, but I think it's a great advantage for BOU to have such expertise amongst our alumni. And I hope that some of your expertise, we can call on it from time to time as alumni members when we need guidance on our future investments.
Sure.
So thank you very much all.
Yeah, thank you. Pleasure to do that.
Visna, just quick note on that one. I think this is also very important. I believe you need to select a good a good bank or a good creditor also, right? Select a good bank is very beneficial to you because they already have those requirements in place, which you cannot break. So select a good bank is also a best choice.
Thank you.
And that link to one of the item Bong Pai mentioned in his presentation is about disciplinary management. With the debt, you are more disciplined because you have to pay back. You have to meet the covenant set by the lender. But even
Yeah.
equity investor, as long as you are not taking your friend, your mom, or your brother and sister into your company, you have all of these covenant set by the investor too. And believe me, the covenant by the equity investor is always tougher than from the creditor.
And at the end of the day, so we encourage you not doing business alone, right? Bring other people, bring investor
Yes.
in, and bring the bank in because they have
in.
skill in there. They set you a regulation. Otherwise, if we take money from our family don't know what covenant mean, right? What to set or what's the good, what is bad covenant is.
Yeah.
Then we can't make a good policy. But if we bring investor in, good friend, like Dr. Chris just mentioned, we are good friend here, maybe.
Yeah,
Then,
bring you are in.
we
Okay, thank
recommend
you.
it.
Any other question?
No more. Thank you so
No,
much.
no, thank
Thank
you.
you. Thank you, Dr. Visna, Dr.
Thank
Thani,
you.
and Dr. Chris. Thank you very much.